Welcome to the T4F video lecture on the character tax planning variable. This is the last out of 4 planning variables, and good news, we've even already discussed some of the issues associated with this variable. You're going to see some familiar old friends like tax-exempt interest. The tax code does in fact permit for differing tax rates in different types of income. We know, for example, that interest on state and local bonds is tax exempt. We have also learned that qualified dividends are taxed at 15%. Both of these represent characters that can be exploited by taxpayers with the correct knowledge. Most income and deductions fall into the ordinary character. I guess the name makes sense. The sale of capital assets creates capital gains and losses, and this is special because long-term capital gains are taxed at preferential rates. Same as dividends, 15%. Unless a high-income taxpayer, and then 20%. Certain types of long-term capital gains can be taxed at 25% or 28%. Short-term capital gains are not treated special in any way. Capital gains are also subjected to an arcane netting process, but we're going to see that later. Of course, everyone's favorite character is tax-exempt, which is subject to a 0% tax rate. Before we move away from the preferred tax rate that applies to dividends and long-term capital gains, I want to dig in a little deeper. So let's look at the 2017 rate table for when you pay 0, 15, or 20% on either qualified dividends or long-term capital gains. And if you look at the way these brackets break, you'll see, for example, married filing jointly. 0 to 75,900. If you look in your table pack for 2017 married filing jointly ordinary rates, what you're going to see is that to the extent your income is in a bracket below 25%, then you actually pay a 0% rate on qualified dividends and long-term capital gains. Then once you hit the 25% bracket, which again for married filing jointly happens at 75.9, all the way up to the very highest bracket, which starts at 470,700, that's at 15%. And then only the very highest income earners, so those in the top bracket, pay at 20%. And these numbers for 2017 match up very nicely with the ordinary income tax rate schedules that, again, you can find in your table pack or in Appendix C of your textbook. 2018 has similar breakpoints. You'll see that, for example, for married filing jointly, due to inflation, we're up to 77.2, is at 0% for single individuals. Now we're up to 38.6, etc., etc., etc. One of the problems with the Tax Cuts and Jobs Act of 2017 is when they put these rates into statute, they did not tie them to the ordinary income tax rates. So, for example, I've pulled out the 2018 single tables, and what you're going to see is if you look at single, the 22% bracket starts at 38.7. But if you look for a single person, the long-term gain qualified dividend rate starts at 38.6. And you would see a similar difference in married filing jointly and also head of household. Because what happened is when they decided what these rate brackets were for qualified dividends and long-term capital gains, they actually used the old tax rate tables and adjusted them for inflation as opposed to matching them up or aligning them with the new ordinary income tables. So just to point out, there are some slight differences between those so that you know when to apply the 0, the 15, and the 20% rate for both 2017 and 2018. And what can only be described as a pretty obvious example. You can see that the after-tax results of applying the different tax rates associated with different characters, strategies to convert ordinary income to long-term capital gains can be as simple as holding the underlying asset for 12 months. It comes as no surprise that it is not so easy to convert taxable income to tax-exempt income. Let's discuss a particularly controversial characterization of income known as carried interest. This refers to the share of investment income that a hedge fund manager is entitled to, and is treated as capital gain. Numerous presidential administrations have tried and failed to change carried interest to ordinary. The current administration is no exception. To implement the character strategy, you must understand the tax law and have some opportunity to change the nature of the transaction. It's more like you will need to plan for the character prior to entering the transaction. Let's read about Bill. Bill has a choice of 3 different investments, and our job is the same as it has been all along. Determine what is the after-tax return. Because the character of the 3 investments differ, the tax rate that applies also differs. You can see that the highest pre-tax return, the taxable bond, does not yield the highest after-tax return. We should also remind ourselves that implicit taxes probably play a part in setting pre-tax returns anyway. We've reached the end of video T4F on character. Thanks for watching.